So types of rate. Now interest rate is what? Interest rate is the price of money which we pay to borrow, and this is the amount a borrower pays to the lender for a given period of time on a given amount. And factor affecting interest rates: time. Obviously, shorter the time, higher the interest rate. Normally, overnight borrowings are costlier than long-term loans. And obviously, the credit risk: higher the default risk, higher the interest rate would be. And interest rates are also expressed as basis points. So 100 basis point is about 1%. Now we have Treasury rate, we have LIBOR rate, and we have overnight rates. So Treasury rates are basically on the T-bills, which are money market instrument less than 1 year. Then we have Treasury bonds, which are normally more than 1 year. These are highly secure because it is backed by government. So there is no default risk in Treasury bonds or bills, or you can say very minimal or negligible default risk if the country rating is good. However, if the situation of Greece and Venezuela and these kind of countries, the T-bills or the T-bonds are also not too much safe. Then we have London Interbank Offer Rate. Now it's an unsecured short-term borrowing rate between banks and also used as a reference rate for various currency transactions and derivatives like interest rate swaps. And it is available in different currencies like USD, LIBOR and Euro LIBOR. So you can have a LIBOR rate into USD, you can have a LIBOR rate for Euro LIBOR. Basically, that is called in Euro also. And LIBOR rates are available for 1-day loan to 360 days period. As we discussed, day count convention is actual to 360 days. And LIBOR rates are determined by bids given by 18 global banks. So as I told you, there's a group of banks. I thought it's 13, but it's 18 global banks. And they give bid on the interest rate prior to 8 a.m. UK time. And these banks are normally rated AA. So these are big banks. And so there is no minimum or no default risk. So there is minimum or no default risk. And highest 4 and lowest 4 are discarded, and then rates are averaged for remaining 10 banks. Now this is really good. So if you're bidding too much high or bidding too much low, these are discarded, and then the remaining 10 rates bids are taken and averaged out for the opening price of the LIBOR rate of that day. Every day this happens. Overnight rates or the overnight borrowings. Banks are normally required to maintain CRR, cash reserve ratios, with central bank of a country. We have to maintain. Now, some banks have surplus CRRs, and some banks have, negative CRRs. So what happens is, if CRR ratio is low, there could be heavy penalty in this kind of situations. So due to mismatch in assets and liability, bank what they do is those banks with a surplus fund with the Fed, they lend it to the banks with lower funds to maintain their CRR, and this leads to overnight borrowing. So one bank takes overnight loan and from the other bank to maintain the short-term crisis, and this can be also rolled over. So these overnight borrowings can be rolled over every day. So this is also option available, and they are normally brokers in between, which matches these guys matches the borrower and the lender's requirement, and the weighted average is taken for all the bids. And Fed sometime intervene in this rate by borrowing or lending if necessary for the financial system. So Fed also intervenes to control the overnight borrowing or lending rates. Okay, because if it is overheated, then obviously it has to intervene. And then what is repo rate? Repo rates are repurchase agreement. So normally what happens is, let's suppose one bank normally what do we understand is the repo rate is the rate at which the central bank lends short-term money to the banks against securities. And it is more applicable when there is a liquidity crunch in the market. And if the borrower does not honor the agreement, the lender simply keeps the security and sell it in the market to recover its money. So money can be borrowed for few months and also overnight, and which is also referred as the overnight repo rate. So basically, repurchase agreements are between the central bank and the commercial banks. Sometimes it is between commercial bank to commercial bank. What happens is if the commercial banks need money, okay, could be overnight and could be long term, okay, could be for in a year also. So they do a repurchase agreement with the central bank, and whatever securities they have, most of the time, collateralized bonds they have. So let's say I'm a commercial bank. I have collateralized bonds with us because we have invested money somewhere. So these are secured bonds and with good quality rating. But because we have, uh, sudden currency, sudden liquidity crisis. So we have an option that we can sell the bonds and we can, get the money. But quite possible that right now the bond market is down, and also possible that the buyer is not available immediately. So how do I get the money? So what I do is I approach central bank and ask them to lend us some money, and in exchange of that I can keep, you know my bonds as a collateral or a security uh, with the central bank and collect the money. And later I'll pay the money with interest, which is normally the repo rate or the interest rate charged by the bank. And I'll pay the principal amount plus the interest and buy back, or you can say repurchase my securities which are held by the central bank. So this happens. So the repo rate or the interest rate, we normally hear in the market that the RBI has increased the repo rate or the interest rate. So that is the interest rate on borrowing and lending by the RBI. And if a bank has to, buy money or take loans from bank, they have to pay that interest rate, and it just not get for free. The bank has to keep collateralized, some collateral with the central bank, and these are most of the time securities, either bonds or stocks. Okay, and also this happens at many times. Let's say I have deposited collateral or securities worth 50,000 crores, and the bank is issuing me 50,000 crores. And after some time, let's say due to XYZ reasons, the value of the security reduces in the market. Now, in that situation, the central bank can ask me to top up. So, give me more collateral for the loans you have taken. So they can, it's not like it is being marked to market. So if the security value is reduced with the central bank, then the more securities can be asked from the borrower. So the commercial bank has to pay more securities. So this happens. Then we have swap rates. So swap we have already understood right now. Swap we have already discussed. Now we have discrete compounding and we have continuous compounding. So for the discrete compounding, we have simple formula, the initial investment multiplied by 1 plus rate of interest raised to the power time t. Simple. But if we have more frequency here, so let's say it is compounded more than once in a year. Let's say it's compounded twice. So we divide it by the compounding. Let's say it's semi-annual compounding. So we divide R by 2 and then multiply the time by 2. So M is like number of times compounded per year for time t. Or you can say M is basically the frequency of compounding. So if you're compounding 365 days, you divide R by 365 and raise to the power 365 multiplied by time t. So this is simple discrete compounding. Similarly, we have continuous compounding. Continuous compounding is normally used in future contracts, option contracts, where the contracts are settled every day, right? Or can be settled every minute. So in that situation, we use continuous compounding. So for formula for the continuous compounding is very simple. That is the spot or the initial investment multiplied by exponential raised to the power r into time t. So that is already daily compounded. So we don't have to put any frequency here. Okay, so it's a daily compounded. So normally continuous compounding will be higher than the return on continuous compounding will be higher than the discrete compounding, because the higher you recompound it, or the higher the frequency, obviously the higher the interest would be. So if we have to solve for r, let's suppose we can simply use this formula. So we have, let's say we can equate it. So for discrete to continuous, so we for r we can have like the frequency multiplied by the log normal ln, and into 1 plus r divided by frequency. And if you want to get the r for the discrete compounding, so we could have m into exponential r is to the divided by frequency minus 1. So this formula can be used to convert the discrete compounding interest rate into continuous compounding interest rate, and this formula can be used to calculate the continuous compounding rate into the discrete compounding rate. So if you really want to compute it from discrete to continuous, you can use this formula. The same formula we used in the calculation of swap using FRM method. Okay, so frequency, that was 2 multiplied by exponential rate divided by 2 minus 1. Right. So measuring interest rate in compounding, as we have already discussed. So if we have simple compounding, we have 10, we have semi-annual compounding, we can have in fact more return. And if you are going for a continuous compounding, we have even higher return. So continuous compounding gives you the highest return possible. So if you more increase the frequency, you have higher return. Similarly, if you are discounting, you will be discounting more using continuous compounding and less using the discrete compounding. So zero coupon rates, so also called the periods spot rate. So zero coupon bond with continuous compounding is quoted at 10%. So in 1 year will grow to this much around. Okay, so here the spot rate which is being used is 10%. And the formula for the bond pricing is like here we have the formula, sum of the cash flows, present value of all this future cash flows. So we will use this thing, the same formula for calculating the bond price. So sum of the present value of all the cash flows we normally take to calculate the bond price, and the discount rate should be different for different periods. So spot rates we must get for different period. So what is the price? Let's say it's asking you a question. What is the price of a bond which is paying 6% semi-annual coupon with 2 years maturity and 100% $100 face value, and zero coupon rates are given as below. So spot rates are given. See, trust me, to get the bond price, you must have the spot rate of all the periods. Then you can only bring the future cash flow of bonds into the present value. So whatever interest you're going to receive on the bond, you have to bring that to present value to get the bond price. But to get the present value, you need to discount it with the spot rate of that period. and the spot rate keeps on changing. So here, let's suppose the cash flow is, let's say, 3 for semi-annual. It is every 6 months getting the 6%. Total is 6% on 100. So for 6 months, it is 3. And we have to bring it to the present value. Okay, so that comes to 2.94 because the spot rate is 4%. Similarly, we will get the next flow, after 6 months of this, and the spot rate here is 4.2. So we have to bring it to the present value. Okay, so we have to discount it for an year, 1 year. And then we have to discount it for 1.5 year. This 3 rupees at this discount rate, 4.5 discount rate. And similarly, the fourth cash flow, we will be discounting this interest with for 2 years at this discount rate. Okay, and finally, we will be discounting the principal amount also with the same discount rate because you're going to receive at the end of 2 years. The present value comes to 91.27. Now, if we sum this present value of all the future cash flows, then we get the value of the bond that comes to 102.57. So the important factor here is we must have the spot rate. Okay. So it says that the zero coupon interest, zero coupon bond interest or return you get, okay, on a bond is normally the spot rate. But the zero coupon interest rate we know for today, we don't know for future. So based on bootstrapping method, we can find out the spot rate for the next period if it is not given. So we'll learn the method how to do that. Also, how to calculate the bond yield. So you can calculate the bond yield either using Excel, or you can get it by using a financial calculator. So if you have a financial calculator, you have to simply press 3 as payment because this is the interest, and the period is 4, so you have to press 4 and then N, and the PV you have to press 102 5.7 and then PV, and then 100 and then future value FV, and then you have to calculate the compute button and IY. So this gives you around 2.72 as the semi-annual bond yield, and you multiply it by 2, so get the yearly bond yield. So why we have this semi-annual bond yield here? Because the N is the number of period is around 4. So you can have N or NPR value there. So that comes to 4. So it is for 2 years. So every 6 months you are getting. So this semi-annual return, you have to multiply it by 2 to get the bond value. Okay. So the price of the bond is basically also considered the par value, and the bond value is the coupon rate. It is called the bonds par yield. In another way, I can say what is a bond yield is a single discount rate. Okay, so we have different discount rates here. We have 4, 4.2, 4.6, 4.74, 4.6. Okay, so bond yield is the single discount rate which brings the bond value in present value to 0. It's equated to 0. So this is the bond yield. This is the actual return basically you are getting on the bond. So one way you can say bond yield is the actual return you are getting the bond on the bond. Other way you can say this is the discount rate which brings the bond value to 0, or the present value, the par value equal to the par value. So I can take some more example here. So we already did this thing, bond value. We have the maturity, we have the spot rates, we have the coupon and the present value of the coupon, and we sum the all the cash flow plus the present value of the bond, and we get the value of the bond. So I can explain it again. The zero coupon bonds is, let's say, 96.08, that is the spot price. Final payment is around 100 you get after an year. So 4% is the spot rate here. See, normally what happens in a zero coupon bond is the zero coupon bonds trades at a discounted price. So let's say 100 face value zero coupon bond could be, let's say, trading at 96.08. So you can buy it 96.08, and after 1 year you get around 100. So you don't have any cash flow in between. So that means you don't have a coupon in between. So final payment is around 100. So you are, how much interest you are getting here is around 4%. Very simple, I did it. So this minus this divided by previous one. So you get 4%. Now this return is basically considered as the spot rate here. So the coupon bearing bonds, what is the difference here? Coupon bearing bonds pays periodic interest. These are called coupons. And principal is paid at the maturity and also called as the par value or the face value of the bond. Okay, this is the principal you pay in the beginning at the times of issuance of the bond. Okay, and the same amount you get at the maturity. So when a company normally issues a bond, okay, through an IPO, okay, uh, that is the first time they call the money, that is the par value or the face value, and there's the same money the bank gonna or the company gonna return, okay, after or at the maturity, right? So this is called the par value or the face value of the bond, and the market value can be different than the face value. So if you want to see some example of the bonds and its price and yield, I can show you. Open nscindia.com and we will see the listed bond on National Stock Exchange. So we have to go to debt market. Hold on. So you have debt segment, corporate bonds. I'm sorry, bond traded in cash market. Now we have the list of most of the bonds being traded in the cash markets. So we have a big list here. But companies are very limited. Most of the NBFCs are issuing bonds normally. So we have total bonds, we have like 103 and 74 and plus 228. These are the bonds we have. So what we can see is we have symbol, we have series, okay. Then we have bond type, tax free, and then we have the rating. So which is given by, let's say for NHEI rating is AAA stable, rating agency is CRISIL. So we have very high rated bonds here. And then we have coupon rate. So this is the interest being paid, annualized coupon rate. This is given. Now this is yield to maturity or the bond yield, you can say, which is actually 6.5. So you are receiving here 7.6, but actually you will be receiving this one. If you are keeping this bond from now till expiry or the maturity, your actual return would be around 6.5049%. The face value or the par value was 1000. So current market price is like 1154. But at the time of expiry or maturity, the company will be paying you 1000 only. Right. So this is the market price of the bond. So if you are interested in buying this bond, you have to pay this much. But at the time of maturity, you will get 1000 only per bond, plus the interest, obviously. Okay, but if you adjust it, your actual return would be around 6.50. It would be not 7.60. So that is bond yield. So there's a change here. There's a 1 day price change because it's being traded in secondary market, that is stock exchange. It is open, high, low, close price of the bond, and this is the volume. So this NHEI bond is, I guess, highest traded, and it's a tax-free bond. So turnover is around 247 lakhs. That is not that great. So around 2 crores only. So very less. People are not investing too much in bond in India. But if you go to UK, bond market is more mature than the equity market. Anyways, the maturity would be on 31st, 11th of January, 2031. Oh my God. So yeah, this is a big, like long-term bond, I guess 20 years bond or 15 years bond it is. So you have different types of bonds here. So if you want to check the a bond which is giving you highest YTM, so that's RHFL. That's giving you around 31 ITM. And it's a zero coupon bond. So you don't have a coupon here. And then we have, I don't know what company is this, EHFL. We have to click and know. We'll get to know. We have DHFL. These are all zero coupon bonds which are giving you high yield to maturity. Last traded price was 690. Now, maturity date is also not given, so I don't know this is being traded or not. So other than that, if we see, these are some bonds. If we click here, we get to know the detail. There's Edelweiss Housing Finance Limited. Edelweiss Housing Finance Limited is giving a YTM of this thing. A coupon of this. Currently, the price is at 991 and face value is this. That's why the YTM is very high. The bond is trading at a discounted rate than the face value. And here the YTM, that's why it's going high. The credit rating is AA by ICRA and is gonna mature on around 19 July 2026. Anyways, let's come back. So how to calculate the price of a bond? Calculate the price of 100 face value bond, and which gives you a 2 years in which matures in 2 years and gives you 4% semi-annual coupon using the annualized spot rate given. So we have to calculate the. So it says why there is face value is not given in some bonds. See, normally I think these are not being traded right now. Or maybe this could be a different type of a bond. I have to find out. Normally zero coupon bonds also has face values. This given here 1000 rupees face value and 2, but in the list it is not given. So in the list it is not given, but 1000 rupees is the face value for the bond. Maybe due to some technical error. There's an N2 series. The close price is 867. You can see if we click it here. V value. The face value is given 1000 and the previous close price is given to 867. Now let's come back. So how do we get the theoretical price bond value? we need to discount all the future cash flows. That is the future cash flow for first 6 months is $2 here in this case, because the interest rate is 4% per annum. So for 6 months it is $2, and we have the all coupons here, and we discount it with the spot rate, we get the present value, and then sum the present value, we get the theoretical price of the bond. So this should be the price of bond. And quite possible in market, whatever you are seeing the last traded price, that can be different than the theoretical bond price. Right, so it can be more or less than the bond price. This is because of the demand and supply. Now, what is bond yield here? So bond yield is the single discount rate when used on all the cash flow, gives a bond price equal to its market price. Or you can say it's the effective return on the bond. So we are using different discount rates here. So it is the single discount rate when used on all the cash flow, gives a bond's price equal to its the market price. So you can see here, let's calculate the bond yield here. So we have, you can use the, we have PM, payment is 2, period is 4, present value is 102, that is the current bond price in the market, and the face value is 100. So we can use the rate formula in Excel. So you can apply the rate formula, rate, or you can use it through your calculator. So you have to use the NPR, that is number, comma, we get the present value, payment, so that is 2, we get the present value, that is this, and then we have the future value, and then close this, enter. So this gives you the value of the yield of the bond. So 1.46. Now this is half yearly multiplied by 2, you get the annualized bond yield. Now, so you get this spot rate or the yield. Now if you apply the same T spot rate in all the periods, and then we calculate the bond value, and we can see that the bond value is 102.06. Now there's a little difference here. This could be due to decimal points, mismatch or calculations and discounting somewhat. Okay. So I'm using exponential here itself for discounting. And here also I should use exponential, here is discounting. Maybe due to some decimal points, we're getting little difference here, but almost same. So how you calculate on the BA2 plus calculator? It's very simple. Start with clearing the time value of memory. So you can press the clear TVM button, and then press the second button and PY to 2, and payment, that is the twice in a year. And then you have the second key, and then quit, and then come to press 4 for the period and N, 102 and minus sign, and then present value, and 100 and future value, and then press second and calculate the PMT, press the PMT. I'm sorry, not second, press 2 as the PMT, and then press compute button and IY. So this will give you the value. So why we do PY2? Because this is payment is twice per year. It is semi-annual. So we have to set the PY, otherwise the result will be not right. If it is a quarterly payment, then PY has to be 4. Okay, and you can get the bond yield using the BA2 plus calculator using this method. So what are forward rate agreements? Bootstrapping spot rates. So let's say we will understand the bootstrapping spot rate. So let's understand the bootstrapping spot rates. Right. So let's suppose we have a bond. Bootstrapping spot rates is used basically to find out the next quarter or next period's spot rate if we don't have the spot rate of the next period. Now, so let's suppose we have bond values. A bond's face value is like 100, and time to maturity for the first bond is like after 3 months, and similar kind of bond has a maturity of half year, 1 year, and then 1.5 year and a 2 year with the same face value. And these are like annual coupons are zero here, so we have zero coupon bonds, and we have the bond price here. So we can simply get the zero coupon discount rate. Okay, so zero coupon rate we can get it. So how do we get it zero coupon rate? It's very simple. What we are doing is uh, we are taking the log normal of D3, that is the face value of the bond divided by the bond price. This gives me the return change interest, and then we take the log normal of this and divide it by the E3, that is time till maturity. So we get the zero rate. So we have understood this thing to calculate the zero rate. This is log ln into future value of the bond, or sorry, face value of the bond divided by the bond price, current market price of the bond, of the zero coupon bond, and then time till maturity. So this will give me the zero rate. So I think this formula we don't need. Zero rate, frequency into element of bond price. So this is perfect. And then we have the second period zero rate. Then we have the third period zero rate. Okay, and now why we are using the log normal? Simple. We are converting the simple compounding returns into continuous returns. So that's why we are using it. Otherwise, if you use simple, and it gives you, you can say in percentage term, let's say it gives you, I'm so sorry, I have to multiply it. I'm so sorry. So this gives you like 1.02256 thing, and what we do is here we are multiplying the n for, that is time, that is let's say frequency 4 times, because it's a quarterly payment, and multiplied by this number k. So we can calculate the zero coupon rate using this formula also. So that is the log normal of this value. So how this value we got is, the formula here is the face value divided by the bond price. So if we divide the face value with the bond price, you get to know how much it is higher or how much return you are generating here. And what you do is you convert that into continuous compounding and multiply with the frequency. So that is around 4. So you get the zero rate also through this method also. So both the method you can use, either this one or this one, to get the zero rate till now. So when we have the zero coupon bonds, it is easy to get the zero coupon rates. It's very easy. Now, so let's suppose we have another bond which is like having a face value, and the time till maturity is 1.5, and the annual coupon payment is $8, and the bond price is 96. Then how do we get this zero rate? So this zero rate we calculated based on the previous spot rates available. So zero rate or the spot rate are same thing. So calculating zero rate for the first, this maturity 1.5 years. Now, so we have the first period zero rate, that is half a month zero rate we have, and we have payment which is 4 times, and we have discounted rate already given here for this half period. And what we do is we get the present value of coupon. So $4 coupon is received every 6 months, and 104 is received at 1.5 maturity, and the bond price is already given, that is 96. So what I'm doing is I'm discounting it. So we have like the payment multiplied by exponential, and put a minus sign here for the discount rate, and multiplied by the time period. Okay, so we get the present value of the coupon. So we are simply bringing this coupon to the present value. So the coupon into exponential minus interest rate into time t. So this gives me the present value of coupon. And then we also get the coupon for second period, because we have the spot rate for second period also, for 1 year also. So we have 6 months, we have 1 year, and then I have to get for 1.5 year. So for 1.5 year, what we have to do is we have to solve it for 1.5 year. Now, so we have what? We have the bond price, we have present value of the coupon, and we have the present value of the second coupon, and then we have the principal amount of the second 1.5 year period, and then we have to solve it for R. So if we solve it for R, we get the value. So how do we solve it? It's very simple. Fine. So how do we get it? Very simple. What I did is, like, we have 3.79, 3.76. So we simply, bring it on the left hand side, and we will reduce it. This comes to 88.60. So if we reduce 3.796 and 3.6 from $96, we get around $88. Now we have to solve it. For this thing, we bring in, like, we divide it, this 88 with 104. Okay, so we get 0.85, and then we have to solve this thing, we will take the log normal of this number to remove the exponential, this power, and then what we do is we divide 1.52 from 6.02, so we simply divide it and we get it like 10.68%. So this is the spot rate we get. Other ways I can tell you. So let's suppose we have first coupon, that is 2 received. We bring this to present value. We have second coupon, which is 2. We bring it to present value. Okay, and then we have final payment at the maturity, and we have to bring it to the present value. Now we don't know the present value R, but we know that the current price of the bond is 102, and I have to solve it for R. So we can get the spot rate, very simple. So you have to solve it. So it's the same thing we did here in this formula and on our Excel sheet. We have the spot rate for the half and first payment period, second payment period we have this spot rate, and the third we don't have. But we know that the current market price of the bond is 96. So the bond price is 96, remaining figure we have, and we have to solve it for R. The same thing we did here. So we solve it for R. So what we do is we simply reduce this number from here, we get this much, and then we have 98.56, and we have to transfer here 102, we divide it, and then we have to solve it for the exponential. Okay, so to remove the exponential, you multiply it with the log normal. Okay, now you divide the value with 1.5, so you get the value of R. And you put a minus sign in the log normal, so you get the value. The same thing we did. So first period we got it. So 1.5 years. Now we have to get it for second year. So very simple again. So second year we have the half year period. We have the second period as 5.9. We have the third period now. So now we have to get it fourth period. So what we do is we have to solve it for the fourth period. Right. So what you have to do, you have to put all the figures simple. So you have the bond price. So bond price is around 101.6. So this is the bond price. Right. And you can put all the formula here. Let's say bond price is like 101.6. So you can put 101.6 equals to the present value coupon 5.694 plus 5.4. This is already present value plus 5.11, and then plus we have the payment, which is 106 here. We're gonna get 106, and now we have to discount this. So raised to the power R into time t. So time is 2 years, so the R into time t2. So if you solve this, you get the discount rate. And so once you have the discount rate, then you can get the bond yield. So because now you have the discount rate of all the periods. So using bootstrapping method, you can, solve for the spot rates. So this is the simple method, nothing else. So I have, broken into parts to explain it better using Excel. Right. So remember this thing to, get the returns converted into the continuous compounding rate. So you have studied the formula also. So remember this thing. If you understand, that's great. That's the best thing you can do. So understood about the calculation of spot rates using the bootstrapping method. So where you got it? Hold on. Forwarded agreements. FRA agreements. Now, FRA agreements also are used to find out the spot rates, okay, or other than the bootstrapping method. So we have discussed this thing in this swap also. Let me see if we have an example. I don't have forwarded agreement example here. So normally in forwarded agreement, let's suppose party A agrees to lend amount XYZ or L to party B through an FRA at an interest rate of RK. Right, so for the time period between T1 and T2. So current time is T0. So let's say from 3 months to 9 months. So 3 months to 6 months. So time 1 to time 2. So RM is the actual LIBOR interest rate observed in the market at time 1 for the period between time 1 and time 2. So payoff from B to A at time 2 will be L into the amount into RK returned at the initiation and return at the actual interest rate observed in the market at time 1, and the difference of time, let's say in case 3 months to 6 months, so 3 months minus 6 months. So this will be payment from B to A at time 2 and payoff from B to A at time 1 be L into RK minus RM into T1 T2 divided by 1 plus RM minus R2, and this will give you the value of a forward rate agreement. So an example here, party A agrees to lent around 100 million to party B through an FRA at an interest rate of 4% for a period of 3 months starting in 3 years. Okay. At the end of 3 years, 3 months, okay, the LIBOR is 4.5%. Find out the payoff. So 1 million into time, the interest rate, that is 0.4, and 3 years, 3 month LIBOR is 4.5. So time 2, we have reduced, and hold on, interest rate, RK minus RM, right? So RK minus RM into the first 3 months divided by 1 plus 0.05. You have to simply put the formula, I don't remember right now exactly, and multiplied by 0.02, and you get the payment at the end of year is around this thing. So the same formula they have applied here, this minus this, and 1 plus RM divided by T minus T2. So this is the formula they applied. Example. So FRE valuation, the part of FRE means 0 as long as RK is equals to RF. So there is no value of the FRE, but there is difference between RK and RF, so which is the at the time of lending and later on. So whereas the RF is the forward LIBOR interest rate for the period between T1 and T2. So this is the LIBOR rate, forward LIBOR rate, which is calculated today. And the value of the FRA S to A now is the amount into RK minus RF into T2 minus T1 into exponential, multiplied by exponential, discounted by the R2 or the LIBOR price into time 2. So as the R2 is the continuous compounded riskless rate, zero rate for the maturity time 2. So R2 we are taking as the spot rate, which is the LIBOR rate of the maturity at time 2. So an example, party A agrees to lend around 100 million to party B through an FRA at an interest rate of 4% for a period of 3 months starting in 3 years. So given continuously compounding riskless zero rate is for 3.25 years is 4.2%. And if the 3 months LIBOR forward rate at the end of 3 years is 5%, so this is the LIBOR rate or the discount rate, find out the payoff. Okay, so this is the RK. Now, so we have 100 million multiplied by the initial rate and the last rate, that is 0.05 into period, that is 0.25 for 3 months, and we have to discount it for the present value. So the interest rate discounting rate is 4.25%. The spot rate is given, and that is for 3.5 years. So I guess is it for time T 3 months at the end of 3 years. So why it is for 3.5 years? Hello. Time 2 is 3.5 years for a period of 3 months starting in 3 years. So it should be 3.325, right? And then we get the value around this thing. So this will be the value of forward from now. Duration. Duration is basically sensitivity with the time. So a measure of the time a bond investor need to wait for cash payment, and the zero coupon bond for n year has the duration of zero coupon has a valuation of n if it has coupon payment of the duration which is less than n. Basically duration is what? duration is sensitivity. Okay, so this normally changes the value of any bond based on the time. So let's suppose we understand the concept of duration here. Let's suppose we have a face value of 100 and we have a maturity of around 4 years and we have a coupon of 10 we receive, and the interest rate or the discount rate is around 6%. So timeline, let's say 1, 2, 3, 4 years. So the present value of future cash flow, we will be discounting at the discount rate 6%. So we are assuming that discount rate is fixed. Okay, so normally the discount rate also changes, but we are assuming here the discount rates are fixed. So these are the present value of all the future cash flows. Yeah. So this is the theoretical bond price today. Okay, and discounted the present value of cash flow with bond price into the weight. So it says that if this is the timeline here, we have first year, and the discounting the present value of cash flow with bond price, okay, into weight, right? So we have here the present value of cash flow now multiplied by the timeline, okay, and divided by the bond price. Okay. So this gives me the factors here. So we have the factors for all of these things. So we again have the bond present value of the future cash flow divided by the time and multiplied by the multiplied by the time and divided by the bond price. So we have the factors here. Now, so duration or the molecule duration, simple the duration, what we do is sum it all up. So this is duration. So this is what? This is sensitivity. So what it denotes? So normally it denotes the sensitivity, or you can say the change in bond price with the change in the interest rate. So if 1% normally interest rate changes, what will be the change in the bond value? So this is a simple duration, and then we have modified duration also. So what we do here is in modified duration, whatever duration we are getting, okay, we divide it with the basically the modified duration we call it. So modified duration, see molecule duration, whatever you are getting is molecular duration divided by 1 plus rate, and 1 plus rate divided by n raised to the power frequency m. So this gives us the modified duration. So this is little better version of the molecule duration. See, this is like right now, this is the sensitivity right now. This is the problem with duration. So there's a 1% change in like interest rate. What would be the change in like bond? So there's around like, this is highly sensitive right now, 3.47. Dollar duration, dollar amount change it is telling you. So 1% change will lead to this much. Now, but it has limitations. Why it has limitations? Because this is based on the current, bond price, which you calculated based on the current available spot rates. But as the time passes, the bond value or the duration may change because the spot rates will change in future. So the right now the sensitivity is this much, but later on the sensitivity can be different or the duration can change with the time. So this uh, does not remain same always. So I said it captures the interest rate risk. So now we have convexity. Now duration is useful only for calculation of small changes in interest rates. Since the relationship is non-linear, so it has the second derivative, basically convexity is useful. So this is change in the bond price divided by the bond minus the D is basically duration, changes yield plus we have to check formula. I am not remembering the formula and I don't have the book right now. So let us keep it convexity for the upcoming class and we can discuss the convexity and that's done. So convexity is basically useful as the relationship of the bond with the interest rate is not linear, it is not flat. So it is good for smaller interest rate changes. But for a longer term period, the convexity adjustment is done. So we'll discuss the formula in the upcoming class. And for today, I'm done. So we are closing half an hour early. Okay, and in the next class, we will have quantitative analysis taken by Manu sir. And one chapter is left for me that is interest rate. I will take it in any gap if there is any leave or anything like that. If Manu sir is taking any leave, I'll cover that into that class. So till now, we're done for now. I'll catch you maybe in some gap. And next class will be taken by Manu sir next Sunday for the quantitative analysis.